Brock, I see your pretty face. Thanks for
It's
joining us today.
100%. Thank you.
Ah, I wish I could bring this many people to a webinar, but
Yeah.
but I can't.
No,
And you really,
goodness
you
gracious.
really, I think it's the way you dress, the way you look. Your office, I think, draws a lot of attention.
Yeah.
Uh, I'm a little jealous. I won't tell people at
Good.
all about your secret that you're able to smoke cigars in there, so I
Yeah,
won't say
good, good.
anything about that. But
Yeah.
um, we got one more minute before we're going to get this rocking and rolling. We got a lot of people coming in. Some of you guys are on the phone. Great of you to join. I'm going to just get started with an introduction for Brock. Make sure before we do this, make sure you text your friends, send something online, take a photo and tag Rotate Digital and Brock and tag us. Let people know that we should do more of these. That would be really encouraging. Brock doesn't need it, but I need that really surface level encouragement. So please do that. Take some photos. We're going to get started. We got everybody popping in here. So for those of you guys joining us, for those of you guys who don't know Brock, you're going to fall in love with him today. Brock is a man that needs literally no introduction. He's the mastermind in the moving industry when it comes to anything financials, accounting, bookkeeping, taxes, literally you name it when it comes to financials. He is the man when it comes to financials and moving companies. He is the owner of Pro Mover Accounting. I think a couple hundred companies trust you all across the USA, big, small, and everything in between. And today, he is going to be dropping some massive knowledge on advanced P&L strategies, tax hacks, tax structuring, really everything you need to know as a business owner to run your business well, get the clarity that you need. So he's going to be dropping that knowledge for us. And I think this is something that Brock obviously thinks it's important. I think it's important. As a business owner, we have to understand the clarity in our P&L. It is one of our greatest assets. And sometimes, Brock, no offense, sometimes we get accountants telling us how to do things, and it's not exactly what we need as business owners. So I'm excited for you to share with us. I'm going to let you take it away. Everyone's ready to go. I think they're going to start writing if you don't start dropping some knowledge. So go ahead, take it away. For you
Yeah.
guys, I'm going to interrupt. If I have questions, you guys can put your questions in. I currently see no questions. So again, if you have questions, put them into the question part, not the chat, but the question part, where it says Q&A. So, Brock, thanks for being here, man. Appreciate it.
100%. Thank you, Travis. Thank you. Thank you. Thank you. And I saw some of our clients on here already, which is awesome. So some of this stuff I'm going to be talking through, you guys will see, but some of it's going to be a little bit more advanced, and you might have some questions about some of the stuff I'm talking about. One thing I will say is this is going to be a little bit more of an advanced review. There may be some rudimentary or elementary items that I just kind of gloss over. And it's because it's really going to be designed for a little bit more advanced review as opposed to kind of a 101 class, right? So, getting started, kind of as Travis mentioned, at ProMover, we only focus on moving companies, and we love it, right? Moving companies are very, very unique, and something that really drew me in long ago was the community of super tight knit moving companies, which is pretty cool. A lot of the Facebook groups and just clients I know a lot of people. There's a lot of interaction, and I love that. But when we started, one of the big things that we realized is the financial education is not very specific to local moving companies. And again, local moving companies are a service industry beast and unique in and of themselves. And so whenever we started our knowledge path on with Pro Mover Accounting and with looking into the moving industry, we started deciding what are certain metrics and things that we see from profitable moving companies, what are certain metrics we see from non-profitable moving companies that make them non-profitable, right? And so some of those things we're going to be talking about today. And again, if you have any questions, please let me know. But I guess the first thing, and I'd love for you guys to put it in the chat or wherever you can, what would you say on a scale from 1 to 5? What would you guys say is your financial intelligence around your moving company, what you know about your moving company? 1 being awful, 5 being I know everything. I don't even know why I'm here. I'm here because I want to jump on a call and sit back in my chair and watch somebody else talk about this stuff for an hour. But 1 to 5, what would you guys say is your clarity on your moving company? Okay, and
Do
I'm
you,
I'm seeing some
I
threes,
was
two
going to
and a
say,
halves
do you
come
see
in.
it? Do you see
What's
it,
that?
Brock, the
Yeah, I
chats?
see a couple. I
Oh,
see
perfect. I
negative.
really want to go into the details of the 1.9 answer. That's going to be very, very
That's
interesting.
right. That's right. That's right. But you know what? A lot of that can be remedied not only from doing things exactly the way that we do them, but in understanding conceptually how a P&L works. We're not going to get into the nitty gritty of balance sheet and income, balance sheet and statement of cash flow and all that stuff. Maybe that's another time. And say cash flow, if that's something maybe later on we can talk about it in another meeting. But I want to talk about conceptually certain things that as we began to build what is good to be looking at in a moving company, why we did that, why we did things certain ways. Okay, so I'm going to share my screen and go through things. And again, if you guys have questions, or Travis, interrupt me if you want to talk through anything specific. But we're gonna hit the ground running. Am I sharing my? Am I sharing my PDF right now? Travis, can you tell me?
You are Gucci. You're looking good.
Ooh, Gucci. Okay. Okay, so I tell you what, we're just going to start with the P&L. And actually, if you guys want to know, this is the image that ChatGPT said is the most average moving company logo. So just a heads up. Also, with this information and with this particular P&L, again, our clients, you may see that it looks pretty normal, pretty much like yours, and that's because, again, we service a lot of moving companies, and every one of our moving companies has almost an identical profit and loss statement. And that's what allows us to look at trends and look at averages and look at goods and bads to understand what is good and bad. Okay. And every year we take away some outlier companies, some very, very new companies, some companies that are, very, very large single location companies that maybe do a lot more than just local, interstate moving and such. And this financial statement, for the most part, is an average of 60 moving companies here in the U.S. So we took the P&Ls, consolidated them, and averaged them, and this is what we got. Okay, so if you want to know what the average is in the industry and you want to compare yourself to the average, this is what it is. Okay. So let's get started. So first off, at the top of our P&L, we have income. Okay. And income is just not income. Sales is just not sales. Okay. There is a number of ways that this number can get put in here. Okay. And PS, January of 2024, and this is December of 2024. So look at this on a 12-month trailing, prior 12-month income statement. Okay. Income statement or P&L. It's the same word, income statement, P&L. Okay. Income can come in a lot of different forms, okay? And I want to share an example of what I mean by that, okay? In January, the average moving company performed $85,000 in sales. That doesn't necessarily mean they received $85,000 in cash. Okay, there's a difference between cash versus accrual basis. And again, we're talking a little bit more advanced here, and so I really want to hit on what is cash basis and what is accrual basis. So I'm going to just share an example. So cash basis, which is a lot of companies that we get in, especially if there's a company that uses smart moving or something like that. A lot of times we'll sync smart moving for this very reason. If we don't sync the CRM, a lot of times when you get deposits for sales, okay, let's say you are performing a job and you get a deposit for the job of $200 in January. Let's say you perform the job in February, and then you receive the payment for the job a little bit after you receive a $1,300 to true up the final job in March, okay, for a job that occurred in February. Cash basis says we received $200 of revenue in January and we received $1,300 of revenue in March, okay? Whereas accrual basis says we received all $1,500 the day we performed the revenue, okay? And the reason we prefer accrual basis is because the day you perform the revenue is usually the day you assume most of the costs as well, right? You have your cost of your truck lease or rent that particular day if you're renting a truck for it. You have the cost of packing material, labor, you have the cost of your truck fuel, all these different costs associated in February. And if we want to be as accurate as we can from a revenue perspective, we need to say we have costs in February and we have revenue in February, and that's accrual basis. It's not to say that if you look back on the trailing 12 and average things out, yes, your cash basis will be correct. But if you're looking period to period or month to month, that's why we prefer cash basis. Okay, so revenue, we prefer accrual basis. Revenue, we prefer accrual basis. Okay, there's revenue. Now let's move down to two other sections of the income statement or the P&L. Those two sections are cost of goods sold and expenses or overhead expenses. You might hear me say expenses and overhead are relatively the same thing. Okay. The reason that we want you to have a cost of goods sold on your P&L and not just have everything in expenses is because it allows us to have other metrics and other data that we can then use to make decisions, okay? For example, we talked about the scenario of performing a move, right? Performing a $1,500 move, and we have a whole bunch of costs associated, let's say, with that revenue. Well, we want that cost first to be in the same period that the revenue is earned, but we also want it to be broken out again in a way that we can use metrics around these items. Okay, so one cost is direct labor. I want to talk about labor a little bit. You want to make sure that when your accountant is doing your bookkeeping, that they're not just saying that you have payroll. Okay, look at your P&L. And that's something else. I highly recommend you guys, if you're at a computer or you're able to pull up your P&L, kind of look through this as we're going through it. Okay, if your accountant is just saying that you guys have payroll cost, there is a lot of payroll in that cost that is not specifically direct cost. Okay. So we recommend breaking your costs into direct labor, sales labor and commission, administrative and owner's pay. Those are generally the payroll items we like to see, and then the taxes associated with those things. So when we're looking at direct labor, we want your direct labor to be, we can throw contracted labor in here. Let's say if you have any contracted labor, that's direct labor, but you also have your W-2 laborers, you have taxes associated with those W-2 laborers, and you have workers' compensation, which you guys all know is awful, right? Those four costs are direct costs. And whenever you're looking at analyzing what your P&L is telling you, there is a certain percentage of sales that you need to be allocating to that cost. Okay. And we'll talk through how we do it here in a minute. But even if you're not using our metrics, you can come up with your own metrics to determine what is an acceptable metric for that cost as a percentage of your sales. Okay. You also have other direct costs associated with cost of goods sold, packing material, merchant fees, so credit card fees, right? Tolls, truck fuel. These are all costs that are directly associated with a job, right? Because we want to look and determine what your gross profit is. And gross profit is simply your sales minus those direct costs gives you the gross profit. Okay. That gross profit figure as a number, not as a percentage quite yet, but as a number, should trend perfectly with your sales. As your sales go up in July, your gross profit should go up in July. As your sales go down in January, your gross profit will go down, right? If you have an accurate gross profit figure, it should trend that way. Okay. And now that allows us to make decisions specifically with break even. We'll talk about that in a minute too. Okay. The gross profit margin, which you guys have probably heard, is just the spread between sales and direct costs, right? The spread of the result of that should stay the same. We don't want your sales to go up and your gross profit to kind of go up and trend, like this, right? We want them all to trend evenly. So that way we can determine, okay, how many sales do we need to make sure that we're making money? Break even. Okay. So we have sales, we have direct costs, then we have overhead expenses. Okay. Specifically with S corporations, which I'm sure a lot of you guys are, whenever we fill out a form called 1120S, that's the tax form that we fill out for S corporations. Okay. We are required to split payroll in certain ways. And owner's pay is one pay that we have to break out separately. So that's why we recommend that you guys have administrative pay. That would be office manager, ops manager that's not going out on jobs, and owner pay, which is you. Okay. We also highly recommend that as an owner, if you are an S corp, you're required to take a reasonable salary. Okay. And reasonable is up for debate, but we won't talk about that right now. But as an owner, you're required to take a reasonable salary, which we feel through metrics should be a reasonable salary. You shouldn't overtake a ton of money, or you shouldn't take hardly nothing, because your metrics are going to be all thrown off. What we generally say is you should take a salary that's the cost of what it would take to replace you as an employee, right? That's going to make your metrics as accurate as possible. So you can, again, begin looking at where you're maybe bleeding in certain parts of your income statement. Okay. After all those things, we have our other overhead costs. Marketing, we consider marketing and overhead costs, bad debt, truck repair and maintenance, insurance, right? Overhead costs are costs that generally stay exactly the same, whether you have $100,000 in sales in January or $250,000 in sales in July. Okay. Generally, well, especially insurance, generally your insurance cost is relatively going to stay the same throughout the year. Okay. That's what we call overhead costs, costs that really aren't going to be fluctuating too much. Okay. So you have your total sales and your cost of goods sold, which results in your gross profit margin. That's going to fluctuate depending on your sales. And then you have your overhead cost that on average doesn't change too much. It may pop up certain times, or, especially with insurance, if you have that true up, a lot of our clients, we see insurance on 9 or 10 months where you kind of pay like 20% of it up front. And then you, over the next 9 months, you're paying in monthly installments, right? So you may have certain months where it's jumping up or dipping a little bit, but for the most part, your overhead costs should stay roughly the same. Okay. Now, you have all of these costs broken out in certain ways, your direct labor broken out, these certain metrics broken out. Why is it important to have it broke out that way? Okay. We're going to go into what we call the pro metrics anyway. Okay.
Be Brock, before
Yes,
you
sir.
jump into that, going back to the cost of goods sold here,
Mm-hmm.
can you just clarify how I'm assuming that the cost of goods sold is going to be basically your direct cost to fulfill the move or to do the move. We got somebody that asking a question about what, like, based on this information, is there a standard profit percentage that they should be shooting for on a move to move basis? So like just accounting for the cost of the move alone to go, hey, you want moves to cost you XYZ amount. Can
Yeah.
you lean into that a little bit?
Absolutely. Absolutely. So there's two phases of that. Okay. The first phase is you're going to figure out what your gross profit margin is. We'll talk about this in a second. But the second phase is you have to have enough sales and therefore enough gross profit margin to make sure you break even. Right. So the two phases is determining what is an acceptable gross profit margin for your company or for your region, but then also how much sales are you able to get to make sure that that gross profit margin covers your overhead expense throughout the year. Okay. That being said, let's bleed into this because that very much is going to be answered here in a second. Okay. We have, again, we call this the pro metrics, but basically all it is, you can do this for yourself, is direct cost metrics and overhead metrics. Okay. And there's some things that fluctuate or they're very small and they're hard to estimate. And so we throw those in other, okay, like tools. Your tolls is going to change depending on where you live and how often you get on the toll roads and whatever. So we don't, particularly estimate that perfectly. We just kind of lump it into a line to be able to estimate it. But basically, we want to know these certain lines and we want to estimate, we want to have targets set for all of these particular direct costs. Okay. Because based on our total sales, that gross profit's going to be eating up some of the gross sales. The overhead's going to be eating up certain gross sales, and it's directly going to impact your bottom line. Okay. So let's assume that your sales as a company is a whole pie. Okay. And I'll have an example. You know what? I'll just bring up the example right now. So let's assume your whole company, all of your sales for a particular year is a pie. If you spend more than your sales, you're losing money. Okay. I think everybody knows that. So we have to figure out how we can spend less than our total sales, but then also the less we spend, the more we make, right? So we want to put in a particular margin at the end that we get to keep as business owners, right? Because remember, as a business owner, we make money three ways. We make it in our wage, we make it in the appreciation of our company and capital, and the third way is we make earnings off of our company. So we want to have earnings in our company, okay? So here's an example of a company, let's say, doing $1.5 million in sales. Okay. Whenever you guys are trying to figure out how much you can allocate towards direct labor, for example, okay, we want to back into it, right? So we can back into certain things based on averages or based on where we're currently at. Okay. You can do this in your own company, right? So let's say you have $1.5 million in sales is what you had last year. And we want to back in to figure out, okay, we want to walk away with, say, 7 to 10% net income. How do we do that? Okay, well, there's certain costs that you're going to have to say, are we going to have the same cost or can we remove it or reduce it a little bit? Let's say administrative payroll. This administrative payroll, for example, is 10.1% of sales. If we want to increase net income 1%, then we have to reduce our cost of administrative payroll 1%, right? Or we have to reduce our cost of direct labor 1%, or we have to reduce our cost of, damage claims by 1%, okay? Um, the whole pie is revenue, and we're just segregating that pie into bite-sized pieces to allow us to understand where we're at a particular part of the income statement and what we need to project for in the coming years to make sure that we're profitable as we grow. Okay. So again, for example, I have a client that a lot of times they'll sit at like 2 to 3% damage claims, even though we want them to be under 1%. But they say, you know what? We would much rather have happy customers, and so we'll overpay on our damage claims to make sure that we have happy customers. Okay, great. That's awesome. Totally commend you for that. However, if we jump from a target of 1% to a target of 3%, that's directly coming off of our bottom line. So you're sacrificing your net earnings of your company, right? One of the three ways you're making money by allowing that to happen. Not saying it's a bad thing, right? But I am saying it's making you lose money somehow, right? If it makes you gain money and top line revenue, so be it. But that's a judgment call that you're going to have to make. Okay. Same thing with, let's say, direct labor. You want to make sure that you're paying your guys more than everybody else, so you have wonderful men that can or women that can work in your company and be able to perform and move in a great way. They're clean when they show up to the job, and customers love them. Okay, that's fantastic. But if they're going to be eating into a little bit more of your earnings, let's say 37% of your sales, it's directly eating into your projected 7% net income, right? We were at 7.4% when we're allocating this out. If you're getting up to 7% direct labor, it's eating into your net income. And when I say 7% and or 37% direct labor, here's what I'm saying to get back to that question. I'm saying whenever you perform a job, okay, the job is $1,000. You're going to make $1,000. You guys should make sure that you're determining how much as a percentage of that job is going to direct labor. We generally say we don't want it to be more than 34%. Go back to here. We don't want it to be more than 34%. So if that's the case, wage, add another 10% for taxes, let's say SUTA, FUTA, and payroll taxes, 7.65%. Okay. And unemployment, or I'm sorry, workers' compensation. So wage, taxes, workers' compensation, all of those things together should be 34% or less of sales. If it's not, two things will or need to happen. One, either you're going to make less money on your net income, right? If you're going to 37% up here, you're eating into your net income. Or two, you're going to need to compensate by increasing your rates, your total sales, to be able to make sure that you're compensating for that increase in wage. Okay. So whenever you guys are looking at estimating jobs, you need to determine how much of that job is going to be direct labor. If my salesmen are making 7% commission, how 7% of that $1,000, $70 is going to the salesman, right? And it's being eaten from my net income. Okay. It's fine if you have salesmen that you want to pay 8%, but just remember you're eating in 1% into your net income. Okay. So you don't have to use our metrics or our targets, but how we backed into this is we looked at what the industry averages were, and we basically said, okay, sales is 100% of the pie. How do we make sure that as we begin to eat our pie, we keep as much profit as we can? We're looking to shoot for a 10% net income for our companies, but historically, the average net income is about 7%. So we want to be a little bit better than average. But I have seen plenty of companies that do way more, 20%, 19%. I just did an analysis with a company that did 19%. You can definitely do it. Let me tell you where you do it, okay? I'm going to move down to this right here, operating margins and net income. Okay, so we talked about gross profit, right? So you have sales, cost of goods sold, gross profit, right? As your sales go up, your gross profit should trend it, right? Where you make a lot of money is whenever your sales go up and your gross profit goes up in excess of that overhead cost. Okay, I'm going to bring up break even so I can show you. Your sales go up, your cost of goods follow. Okay, and the difference between this gross profit margin. You have a particular amount of overhead that you're paying every month. Let's say $40,000 in admin wages and rent and all, warehouse rent and all sorts of things. Okay. Where you are making money is once this sales net of direct costs eclipses your overhead amount, which is why historically moving companies are making money during the summer months when their sales are high and losing money during January and December when their sales are low. Their margin still may be fine. In this example, a lot of people have eaten their margin in December, or that's what it's showing anyway. But let's say 43% on the wings here. It's not terrible. We at least want 45%, but it's not terrible. Their margin isn't changing drastically, but their net income sure is, going from -4% to a positive 19%. And that's because as your sales go up and as your gross profit goes up, that overhead doesn't, right? The overhead relatively stays the same. And so once you can get over and eclipse that overhead cost, right? That's where you're making all your margin. So the key here is two things. One, you want to make sure you have as much operating margin or gross profit margin as you possibly can. But two, you want to make sure that your overhead cost is as low as possible, right? The lower your overhead cost, the lower required sales amount to hit that break even, right? Because again, you have this segregation between sales cost of goods sold, which then results in gross profit margin. Once that gross profit margin eclipses your overhead cost, that's where you're making money. So if you can increase that gross margin or decrease that overhead cost, you're making it's becoming a lot easier to make money throughout the year. Okay. We like to recommend doing that exercise out here on the wings of the year, right? November through February. If you can figure out what it takes your company to be profitable between November and February, that's when you can make an absorbent amount of money during the summer months, because now your overhead costs low, you have that ability to make more sales, and your net profit margin just really, really goes up. Historically, that's what we've seen. Okay.
Brock, real quick
Yes, sir.
on this operating margins, kind of go back to get a little bit clearer of an answer for
Mm-hmm.
that, like what you should be targeting for the hard cost of the move. If
Mm-hmm.
the gross profit margin is sitting around somewhere between 47 and 49%, are you arguing then, and this may not be the average, I think actually it does say average, but are you saying then, roughly speaking, a good starting target would say, hey, if the move is going to cost you hard cost 60% of the revenue, that's a good place to be starting at? Or are we reading this, or am I reading this wrong?
You're If the move is going to cost you 60% of the revenue
Yeah,
for a
so let's say I
40%.
do a move for $1,000.
Mm-hmm.
This right here, this black line is saying that in June of 2024, that basically I'm keeping 490 of that $1,000. So it's the cost of that move was basically roughly speaking 50% or 51%. Is that correct?
You got it. You
Okay, so
got it.
that would be a rough place to be at, to go, hey, if you can go, you keep 50 cents on the dollar for your move, or it's costing you 50 cents on the dollar to fulfill your move. That's a great place to be aiming for as an owner.
That is fine. Yes, but again, it depends on what you're counting as far as costs, right? So that's where it matters what is in your cost of goods sold on your P&L, because if you don't have, we have sales, labor, and commission kind of roped in here, but if you don't have your cost of your salesman in your cost of goods sold, then that's going to change your estimate of how much you need to take away to make sure that your gross profit is strong, right? But you're exactly right. 50% is a nice round number to try to reach, knowing that it's pretty hard to estimate what your damage claims are going to be, and so on and so forth. If you're looking to get a 50% margin, that is basically double the costs. So in a perfect world, you do an estimate and you know exactly what your costs are, $500, let's say, to perform a move. You charge double that, $100 or $1,000. Then you realize that once the job is done, you're going to walk away with the difference, $500, which is a 50% gross profit margin. You absolutely got it. Yes.
Got it. Thanks, man.
Yes. Now, and I know I'm moving quite along here. Let's assume after this,
Real
you've
quick,
dialed
sorry,
this.
before you move along, one
Yeah, yeah.
question came in that I think is relevant. It says here, is cost of goods sold expense factored as a per job basis or overall for materials purchased for the company within that month?
Great question. Great question. This goes into the difference between accounting metrics and what you're looking at in your P&L and what you need to be reviewing from an operations perspective because they're different, right? Your P&L is the table of contents to the story that your company's writing, okay? Your P&L is not going to tell you everything, okay? You can try to make it tell you everything, but what we've seen is if the more convoluted you get and the more practices you have to put in place to make things minutely accurate, cost accounting, which we won't get into, and all that stuff, the more chances of inaccuracy you are. So a lot of clients will come to us and they'll have a P&L 3 times as long as what we have, and they just can't make heads or tails of it, and we couldn't either. So that's why the first thing we do when we get a client is we can condense it, consolidate it, and make it readable to allow you to pinpoint these 12-month trailing averages so that you can look at the company from a holistic perspective, not a day-to-day perspective. But when you're estimating and you're doing your operation, your weekly ops calls and things like that, that's where you need to be digging into costs per job, for example, right? Because those small details are going to allow you to make the changes that globally will result in profit. Does that answer that question?
I think it does answer that question very well. I'm going to ask one more question, but if you feel
Yeah,
like it's a longer answer, I want you to continue on and we'll hit this at the end of the webinar.
perfect.
But the other question was, well, then what specifically should I be looking at to put in this cost of goods sold category? Because it seems like everyone's doing it their own way. If you
Mm-hmm.
go, that's a long answer or something we want to get into later, let's hit it at the end. But if you feel like it's relevant now and you can answer
Yep.
it, do it now.
Let's talk about it. So again, like I said, everybody does their P&L a little different. And accounting truly, I know it seems super logical, but accounting is very much an art. Everyone does it different, and so it really depends on why you want to put things in certain places. Okay? So for example, your cost of goods sold should be the costs that are 100% directly tied to the generation of a sale. Okay. So if you really, really want to take the time to allocate your marketing spend, for example, in certain ways, you could have pay per lead, for example, in cost of goods sold, whereas SEO is going to sit in overhead expenses, right? SEO, you're paying, $3,000-$4,000 a month every
Yeah.
month.
SEO, you're
Generally not.
paying ten to
Oh,
$15,000,
that's right.
right? Okay,
Yeah,
we want to make sure there's a good budget for SEO, I've been told.
that's right. $10,000 to $15,000 is a great, but that's right. That's right. So, SEO is generally not going to fluctuate too much throughout the year, whereas pay per click is definitely Google PPC is definitely going to fluctuate, right? Because you're going to be getting a lot more leads during the summer months, let's say. And so, if you really want to dial it in, you could have PPC in your cost of goods sold, but cost of goods sold is just basically to allow you to understand what are the costs that I am going to have if I perform a move, and what are the costs I'm not going to have if I'm not performing moves. Okay. A lot of these overhead costs, theoretically, you're going to have whether you have $100,000 in sales or zero in sales. Now, any normal businessman is going to start cutting things if they have $0 in sales. But, theoretically, if you have $0 in sales, you're still going to pay your admin, right? You're still going to pay your insurance. You're still going to pay your warehouse rent costs, right? But you're not going to be paying direct laborers. You're not going to be paying truck rent. You're not going to have any damage claims if you don't have any jobs. So the best way to do it is how you can easily calculate those costs to understand if I perform a move, what cost am I going to have associated with that move? No matter what, that's a direct cost. Okay. There's a lot of people that challenge us on this truck lease and rent, right? Because if you're renting or leasing your trucks, we assume that that's a direct cost. Why? Because most of the time, lease cost you're paying, flat per month, but also per mileage. And so a lot of times you're using more trucks, you're renting more trucks, let's say during the summer months, or you're driving more miles, because you obviously have more jobs during the summer months. And we see this fluctuate with sales. What we don't see fluctuate with sales is loan payments on trucks, right? You're paying $1,500 a month, whether you use the truck or not. That to us is considered an overhead cost. And so when we're looking at our direct costs, we want to look at the costs that are 100% perfectly associated with a move. And if it's not, it's an overhead cost.
I love that.
Does that
I'm
make
gonna just,
sense?
yeah, I love that. I'm just gonna regurgitate this in a
Yes.
in a in a dumb version for
Yeah.
people like me, I think it's a really good kind of wisdom principle to just say, yeah, don't get caught up in the details, but just think what is fluctuating for the move and changing. If you tripled your sales, what is going to triple in cost that month? And that probably is a good indication, principally, to go put in your cost of goods sold. Is that a good
Mhm.
way to sum it up or no?
That's a great way to sum it up.
Cool.
That's a great way to sum it up.
Love it. This is
Um,
great. Keep it going, man.
and I tell you what, I don't want to go super long winded, so I'm gonna hit on one big topic, and we can get in. No, I should hit on two big topics. Let's talk tax, and then I want to talk budgeting as well. So, okay, now when you're moving company, you've created profit, right? You've got a decent gross profit margin, decent sales, decent net operating income. I really want to get into what's next. Okay. So if you're just if you own a moving company, you got a single location, you're doing $1 million a year in sales. I love it. I hope you're profitable. I hope you're making a ton of money. Making that an S corporation is a great idea. Generally, I'll say generally, consult your accountant. I got to throw that in there. But generally, it's a good idea because it saves money. I'll talk about how it saves money. But this structure is the structure that we generally recommend for a company that's going to be opening multiple locations. Okay. Let me talk about S corporation, and then let me talk about this. So as a single member LLC, okay, if you do not have an S corp status, I definitely do not almost never recommend a C corporation status. If you're a C corporation, if you have a foreign investor, you have to be a C corporation. If you have different classes of stock, you have to be a C corporation. So there's certain requirements that would make you be a C corporation. You're double taxed. Don't recommend it, but sometimes you may have to be into that category. The other alternatives is either a single member LLC, a multi-member LLC, or a partnership. Those are it's a form 1065. Those use the same form, or an S corporation. Those are all generally what we see. A sole, you could be a sole prop, but we highly recommend you get an LLC and use an EIN. Okay. If you are a single member LLC or a partnership, you don't take a W-2 payroll. If you're taking a W-2 payroll, your accountant's telling you to do it wrong. Okay, don't take a W-2 payroll unless you're an S or a C corporation. If you're not, and you're a single member LLC or a partnership, then the earnings that you make in your company are off of the net income. Now you may say, well, I take draws. That's my pay. Well, all draws are you drawing value of your equity? Okay. Your company is making, say, $100,000 net income, 10% on $1 million in sales. Your company's making $100,000 in net income. You're taxed on $100,000 if it's adjusted gross, after depreciation, all that stuff. You're paying tax on $100,000 if you take money out of the company or not. Okay. We won't even get into basis, but basis kind of tracks your value in the company that you own. Okay. It's kind of like equity in your company. So if you are making $100,000 a year in net operating income as a single member LLC or a partnership, that's generally where we begin to recommend an S corporation. Now, an S corporation is simply an election. It doesn't change your liability to different companies and so on and so forth. But what it allows you to do is escape some of the payroll tax requirement that the government has. Okay. And what do I mean by that? On one hand, once you would elect S corporation status, you have to take a W-2 payroll. Now you have to join your payroll with your employees, right? You have to have a W-2 payroll, and you have to have a reasonable wage, which can be difficult to calculate. Again, talk to your accountant to calculate what a reasonable wage is, but you have to take a reasonable wage. However, let's talk about payroll taxes. So for your employees, whether you know this or not, you are paying 7.65% of their wage into the government for Social Security and Medicare. Okay. Every employee is required to pay 15.3%, and half of that, 7.65%, they pay, and the other half, 7.65%, you as the employer pay. So that's why people like contractors. A lot of states aren't going to allow you if you have certain, limitations. In California, for you guys, I'm sorry. You're just not allowed to have contractors, right? Contractors, you don't necessarily have to pay for that, but for W-2 employees, you do. Okay. So again, as a single member LLC or a partnership, all of your $100,000 in earnings are subject to that 15.3%. All right. So on $100,000 adjusted gross income, you guys are paying $15,300, and you do not get it back. Okay. You can show that you're, not making money or somehow. But if your adjusted gross income is $100,000, you're paying 15.3%. You never get it back. Okay. If you are an S corporation owner, though, you do have to take a wage, and that wage is subject to Social Security and Medicare, just like it is 100% if you're a partnership or a single member LLC. Okay. That wage, let's call it $50,000, is subject to 15.3% tax, Social Security and Medicare. You're paying $7,650 in taxes on a $50,000 adjusted gross income. Now, the other $50,000 of the earnings that your company had, right? You had $100,000 in earnings, but $50,000 now goes out in a wage, so you have $50,000 left. That $50,000 of adjusted gross net operating income, we'll call it, that is not subject to Social Security and Medicare under an S corporation status. So it saves you $7,650. So you can very much see that as your adjusted gross income goes up or earnings for the company goes up, your tax obligation massively goes down. And that's why an S corporation is so beneficial. Okay. Feel free to ask any questions about that, but I'm going to keep moving on.
Oh,
So
we got a couple
now,
of questions.
okay, go ahead.
Can I pause you real quick?
Yes, you may.
And we'll try to spitfire this. What was the revenue you suggested to start considering an S corp?
There's no revenue suggestion, but it's net income suggestion, right? Whether you make $1 million or $10 million, it's what is the net income of the company, right? After depreciation. After depreciation. After depreciation, if you have $100,000 of net operating income, you should be, if you're a client of ours, we're probably going to recommend you be an S corporation. Okay. If you're sitting at $50,000 of net income, it may be, but you got to take a reasonable wage anyway. So most of that net income is just going to translate into W-2 wage, and you're going to have zero net income on top of that. So you might as well just, stay in a single member LLC. Again, the liability is no different. But an S corporation is going to cost more for taxes and filing for your state and federal. It's a lot longer form. It just takes an accountant more time. So that's why we say $100,000 in net operating income.
$100,000 in net operating revenue.
Net operating income.
Thank God I'm not leading this webinar today. So
let me show you what that means. Right. So again, we talk income or sales. We talk costs. We talk expenses. After that, you have net operating income. Okay. That net operating income is really what you need to be using your net metrics on, but you're taxed on your net profit. So you have charitable contributions, you have, depreciation, kind of those non-operating costs. You're taxed on the net profit, which is after those, other tax entries are made. If that makes sense.
And then Justin Doe says here, and maybe you can know where he's talking about, and I don't remember. Does this apply to LLC filing as an S corp? And Justin, I don't remember what context this was. So Brock, if that doesn't make sense to you, I'll have Justin clarify that.
No, it does. It does. There is not many companies that are not an LLC filing as an S corp. That there's a status that you can, like when you start the company, you start it as an S corporation and it's not necessarily an LLC. We don't really have any of those. Most clients that we have anyway, most people that we're working with are LLCs. They start as a single member LLC and then they elect to be filed as an S corporation. That's where you get that K1 for your taxes and such. The K1 is what's telling you the company made. You're paying taxes on that personally through the Form 1120S. So yes, Justin, it's the LLC filing as an S corp.
Okay. And then I'll do one more, and then we'll come back to all these. Guys, put your questions in the Q&A. These are amazing questions. If you have a question, other people have a question, we will have time to answer these, and we'll probably kind of slow down and finish up in the next 10 minutes and go straight to Q&As because there's a lot of them, and I think that'll be beneficial. But I want to ask this one. My good friend Amber said, our accountant wanted us to be a C Corp. So I definitely need to set up a call with you because our holding is at the top of the structure. And so I just wanted to clarify, you are willing to take on new clients, Brock, correct?
Yeah, we will definitely take on new clients. Now just know it's the end of January. So we're getting hot and heavy in it. A lot of times for clients that we onboard after January, it's like, hey, we got to put you on extension because there's a lot of things we have to collect. But yeah, more than happy to get a call scheduled with you, myself or a CPA here on staff to to help iron it out. But again, there could be a reason why they recommend that. There's certain things that a C corp is required for. Again, if you have foreign investors or different class of stock or more than a certain number of shareholders or things like that. Okay, so I don't want to just say they're doing it wrong, but generally at the top up here, it's a trust or you, and then generally we want to recommend an S corporation. I'll also say you only have to pay Social Security and Medicare up to like $280,000 of income or something like that. So if you're making $1 million of income, it's not going to help you past that because you don't have to pay on Social Security and Medicare anyway. So just a heads up.
Love it. All right, continue on, baby.
Okay. Now we have the owner. Let's say an owner or a trust. I'd recommend this top part be a trust. We won't get into that. But then the owner owns a holding company. That's generally what we recommend be a S corporation. Because let's say you have multiple locations, multiple entities. Now you can start this corporate structure of owning these little individual entities that all flow up to the parent S corporation. Okay. There's a lot of people that will have multiple companies and they're all S corporations because they know the benefit of S corporations, but then they're getting 5 W-2s, right? Because you're getting a W-2 from every S corporation. And an S corporation cannot be owned by a company, right? An S corporation has to be either owned by a person or a very specific trust. An S corporation cannot be owned by a company. There is a fancy way to get around that we do. It's called a Q sub, but I'm not going to get into that. But for the most part, these subsidiaries just are simply LLCs with a single member being the parent company. Okay. And so if you guys are looking into franchising is a whole different story, but if you're looking into starting multiple locations in different places, what we recommend the setup be is you at the top that owns this S corporation holding company. And then each of these individual entities are separated through liability, right? That all their income flows up to the parent company. So we recommend, for example, having a truck holding company. And this truck holding company buys all of your truck. If you're ever buying a truck or one of your newer locations is buying a truck, the truck holding company buys the truck. The truck holding company pays for the debt. And these individual entities lease that truck from this parent company, right? One, it helps segregate the liability through the limited liability veil. Okay, there is a veil between these companies, and you might have heard of piercing the veil. If you're doing things wrong, you can pierce that veil, and liability, opens up to different entities. But segregating these companies is how we recommend keeping good liability, holding insurance on each of these companies, but also for metric analysis. Okay, if you have your main company and you have other subsidiaries kind of off of that, a lot of times that main company's funding everything else, right? I'm sure you guys know what I'm talking about. This main company can buy a new truck, and so it gets a new truck and it's paying for the loan for the truck, but this entity's using it. Well, now if you truly have the earnings segregated, this company is artificially making more net profit than it actually should be because this main, the first company is paying for some of the liability and some of the debt, right? So now your metrics are off, and it's better to not have any metrics than wrong metrics. Really, it really, really is. Okay.
I have two questions on this, Brock, real quick. Number one, where would you then take the payroll from each location? Would you take it from the holding company, or where would you take that?
So each individual company that's a great question. Each individual company can have their own payroll. Okay. However, the owner, maybe the owner's wife is involved from a managerial perspective. Maybe you have a chief of staff or some chief of operations that kind of oversees multiple locations. Those employees should be sitting at the top. Okay. Because then you can allocate the cost going into this company to each individual entity through a management fee. All right. So you can have some sort of administrative management fee. Here's a prime example. If you have a CRM that allows you to have multiple locations, a lot of times we want the management company paying for that. And then the management company will just simply once a month bill these individual entities for the number of, for revenue or whatever, based on a certain metric to create the billing. If this company over here is doing 3 million a year in sales and this company is doing 1 million in sales, they can't naturally be paying the same amount to the holding company for that subscription, right? We would say segregate it based on revenue, and this company pays 75% of the the CRM bill, and this company pays for the other 25% of the CRM bill, right? And you can again, you can go very, very far down this rabbit hole, and obviously the cost begins to grow depending on how much time consumption you have into this. But that's how you become very, very accurate in the breakout of the analysis. And you want to be accurate. You want to know that this new location you're setting up is or is not profitable. If it's not profitable, if you can see through accuracy that the location's not profitable, you're going to make a different decision about the longevity of that location. Or you look at it and you see it, it's either killing it or it's doing awful. That's going to allow you to make decisions. And the name of the game in all this stuff is getting the right information to be able to make educated decisions. Does that make sense?
Yeah, this is phenomenal. So when you said advanced tax strategies today, you meant it.
Oh yeah.
Another question here then, does the
Yep.
separation you have here, well, let's answer this question. It'll be a quick answer. Does this mean that each LLC has its own QuickBooks, its own P&L, and then each one of these are filing individually at the end of the year, or do they go each QuickBooks, each P&L, but they fold up into the holding company in just one file for the end of the year?
So we recommend, if you're using QuickBooks, which we recommend a QuickBooks for each location. They are different entities. Okay. Now, most of the time you can kind of get away without having accounting software for some of these other entities, just because there's not very many transactions in there. If there's like 100 to 150 transactions for a year in a bank account, we're probably going to say, don't worry about the $40 to $60 a month for QuickBooks. You just have your accountant do it based on a file at the end of the year. And please, for every accountant, please give them a CSV file, like an Excel file versus the bank statements. That's awful. But if you get a CSV file from January 1st to 12/31, a spreadsheet of all the activity, it's generally pretty easy to sort and understand where the loan payments are coming from or management fees going to or whatever. So you don't have to have one, but a different QuickBooks, we'll say, for every location, but definitely for each moving company, you would want their own
Got it.
QuickBooks
And
for
each
sure.
one of those are filing at the end of the year, or is it one S corp filing?
So all of these roll up into one S corporation filing. Yes.
Guys, yeah, this is so relevant. Put a one in the comment, guys, if this is super relevant, because we got filings coming up here shortly.
Mm-hmm.
Another question coming in that's relevant here is, does this separation apply to same company, sole owner, but with multiple locations?
Got you. Not necessarily. So the alternative you can do there, which can get a little tough, but QuickBooks, for example, has location or class reporting. Okay, and you can basically run your company with multiple locations through one QuickBooks. The problem is, without getting into something that we call modified accrual accounting, which is what like government entities use, you're going to have one balance sheet, right? You can't have more than one balance sheet for multiple locations in one QuickBooks, for example, right? So you can have basically parallel income statements. So you could run one particular month, let's say, and that one particular month kind of looks like this. Like you have your chart of accounts, and then you have location one, location two, for example, right? And you can run it for January and see the sales for each location. You have to break everything out segregated by entity. You can do that. The problem is it gets very, very, very convoluted, and 90% of the time it's too much, and the owner just ends up kind of doing it halfway. And, like I said, it's better to not do anything at all than do it halfway and have wrong information you're making decisions on. Does that make sense?
Yeah, it makes sense. One more question.
Yeah.
And there's still a lot more. I'll let you finish up here after this question,
Yeah.
I promise. With the truck holding company on that LLC here, who's actually securing the insurance coverage? Is it the original S corp or the holding company who owns the trucks? Like, how does that process go through? High
Great
level.
question. Great question. Generally, what we see is it can either be this holding company or it can be this truck entity. A lot of times we want it to be this holding company, but as you guys know, if you start another entity with another LLC, your insurance company's like, you should probably be on Progressive because it's the new company, and then you just get murdered, right? So a lot of times we want it to be on the parent company, and then when you're adding a new LLC, it's the same company. Even for tax purposes, it's the same company. It's just segregated for liability purposes. So if you have the holding company pay for the insurance, then when you add or take away locations, it's relatively easy to just manipulate the insurance to make it fit your needs, as opposed to try to have insurance on each individual entity. And then, it's getting pretty convoluted, and you have that 2-year waiting period of, you're paying an arm and a leg for your insurance.
Love it. Thanks for answering that.
For sure.
Let's like maybe go for another 5 more minutes.
Perfect.
I want to respect everyone's time. We've already been demanded with firearms and an army riot to do a round two of this here in the next few
Love it.
weeks. So we're gonna get that going if
Sweet.
you're so open for it. But let's maybe kind of finish up the last 5 minutes or
Yep.
so of things, and then we've probably got 20 minutes or less of questions to run through. And I know that that's
Okay.
really important for a lot of people to get those uh, questions run through. So go ahead and keep it going, and we'll get that closed up for questions, guys.
Perfect. I would say part two, we definitely need to talk about cash flow forecasting, the benefit of that, how to do it, how we do it anyway, and the benefit of it. Recommended minimum cash balance. This is something else for a lot of people that are just like, oh, I have money in my account, but I don't know if I should spend it. If you guys are kind of running your business on your bank account balance, the first step is to understand what number do you not want to go under. And so we have a fancy way of calculating what number we don't think you should go under. And so we can talk about that another time. But the last thing I want to talk about, which is arguably one of the most important things after you get an accurate income statement or P&L, is budgeting for that P&L. Okay. So talking about trying to find costs that you want to remove, this is how you do it. Okay. For clients that we have that are either advisory or fractional CFO clients, we do a budget every year, and it's 2 to 3 hours long, sometimes longer, because we go through as you should do. You go through every line item and you project your income and you project your gross profit because based on your direct costs and the margins and such associated with that. You should go through every income statement line item you have and say, I think I think my accounting fees are going to be this much a month for the next 12 months, and therefore it shouldn't be over $10,000. Or you shouldn't pay more than $150,000 in SEO fees every year, right? So when
Hey,
you're
Brock, I
estimating,
can kick you off this webinar anytime I want. So just be careful with what you say, okay?
I'm sorry, I apologize. I said 150. I mean, come on. Um, you need to be budgeting every one of these line items so that monthly or year to date, you can look and you can say, oh, you know what, we had budgeted X and we're over budget. Why? Why are we over budget, right? Why are we under budget? If we're under budget, we're super happy. There may be, like right here, there's something funky going on with office expenses. What's going on with office expenses, right? Why are we over on our entertainment? We had an entertainment budget of say $100 a month, and we're at $3,100. Why are we over? And how do we make sure that we don't go over next year? There's $2,000 right there that we save by simply having a budget. We want to have a Christmas party, and instead of spending $5,000, we're going to spend $3,000. Okay. You have to remember that, especially being the sole owner, every dollar that's spent is your dollar. You're writing a check for every expense you have. Okay. And so whenever people are being a little gluttonous in your company, they're spending your money. And if you think about, giving your employees access to your personal checking account, right, you're probably going to be a little bit more, hey, why do we really have to, buy 3 boxes of blank paper, or can we just get by with 2 for now, right? So budgeting allows you to be a little bit more restricted in your spending, as you should be. We're restricted in our personal spending. Why aren't we restricted in our business spending, right? So that's what I'm going to leave you on, is you don't have to have anything you don't have to have your P&L exactly how we have it to be able to look at it and make sure that you're calculating your expenses. Okay. One of the most valuable things you can do after you get your P&L in order. How's that, Travis?
It's beautiful. I
Good.
turned on my pretty little camera here
Good.
and see if Garrett can make spotlight. Man, I lost so much hair when I started running a business, and I started looking at my P&L, and your hair just is a flock of beauty.
Oh, thank you. Thank you.
Guys, Brock, thank you so much. I wish we were in person so we could give you a big round of applause. If you guys could give a comments a round of applause or something, because that was
Thank you.
phenomenal.
Good. I hope it
Don't
helped.
leave
Yeah.
yet. We've got some real good stuff coming up. We got a lot of questions, and I want to give everybody the ability to get these questions answered. Here is what I ask in return. Brock has spent hours and hours and hours preparing for this to give you guys as much value as possible. I have to be so clear with everybody. I know you already know this. This is $2,000, $3,000 of consulting that you just got in a free webinar. So here's what I ask right now. In order for this to be beneficial for Brock and for him to continue to keep this going, I have two asks. Number one, take a photo, a screenshot, whatever, and tag Brock and tag Rotate Digital and put it on your Instagram and your Facebook. That will give him the encouragement to do this again. This will be so beneficial for him. Please tag him and get that on social so other people can see this man, the myth, the legend. Okay. Secondly, here's what I ask. Go into that Moving Company Owners Unite Facebook group. Go into some of the other moving company Facebook groups. Find a post that was talking about this and just comment or do a new post and just shout out Brock and how great this webinar was, so we can get more people to join so Brock can drop some more knowledge and some more fire and some more information for us. So that was phenomenal. Thank you seriously so much. What I'd love to do is be very selfish here and start transitioning into the questions.
Okay.
And so for
Love
those of you guys who have to go, you have to go. That's fine. We will try to get a recording of this, but maybe we won't do the Q&As to get people to want to be here for the live version. We'll see what happens. But let's kind of go spitfire through. You can spend as much or little time on this as you want. I'm gonna pull up one that I think you're gonna have to screen share for. Chris Hunt said, "What is line 5010 payout to locations referencing? What's all that about?"
You know what? That let me look at it again. 5010 payout to locations. Okay. That was one specific company that we had when we brought it, one or two when we brought this in. A lot of times whenever you have this multi-entity structure, you have specific costs that are being allocated to different companies, right? So let's say you have one specific location that is, again, maybe you're not using a management company to pay for a lot of your expenses. Maybe you're using one company that has a fuel card and that company is managing on the fuel card, and then just bill it out to each individual location, right? If you have that cost, you want it to be fuel cost on your income statement. You don't want to just have management company one to the other because now your gross profit's off, right? So that we don't have a lot of companies that have the line item payout to location, but if you have multi-locations, you're just going to have different line items on your P&L. So that's what that's for.
Beautiful. Thank you for that answer. I
Sure.
appreciate that. Another question. Where does the owner draw go if you're taking a bonus 4 times a year? Because the answer to I want to answer that is it goes right in my pocket. But I think there's a different answer of like, where does it go on the P&L or the balance sheet? How do you look at that? Go ahead.
Okay. Owner, that would be considered an owner's draw. I'm thinking they're talking about an owner's draw.
Yeah, where does the
Um,
owner's draw go if you take kind of like a poll every quarter? Where does
okay.
that go? Is that going into your P&L? How do you want to
Gotcha.
look at that? In I'm going to kind of give my insight on that is
Mhm.
because there's a combination of taking an owner's draw of what you really should be paying as a salary, and part of that wanting to be on a P&L to be like, hey, I need to protect this money when I hire somebody. On the flip side, it's a reality of it's just purely an owner's draw for taxes. So where does that
Mhm.
go? How should you look at that as an owner?
Yes. So that's why we like the S corp setup and the owner the W2 that the owner takes. We like that setup because if it's a bonus that you are paying out to all of your employees and then you're also getting a bonus, then that's an expense that you would have if you had someone in your place, right? And so I would say that should go, that it has to be a W-2 pay, right? But as an owner, if you're just pulling it out because the company has some pretty good cash balance right now, and you're like, oh, I want to take some more personally, you are pulling value out of your company, right? Your business has generated a cash balance and you're pulling that out. You're pulling equity out. And when you pull equity out, it's called an owner's draw, right? So that would go on the equity portion of your balance sheet. We didn't even talk about the balance sheet, but that would never touch your P&L in that case. It would never touch that. It would come directly off of the balance sheet. And that's where you can really dig into cash flow, right? And if we do this again, that's something I'd really like to touch on is what is the cash flow and why is the net income not the same as my change in cash balance, right? The owner's draw has a lot to do with that. So yes, if you pull the money out of the company as an owner's draw, it comes off of the balance sheet, coming out of the equity of the company, not an expense to the company, not on the P&L.
Beautiful. Just a nice little preview for round two in a few weeks here. So
Sure.
love that question. Question for you guys, for you, Brock, specifically. Do you guys do one-on-one consultants? Again, glad I'm not doing
Consulting.
the
Yeah.
webinar. Do
Yeah.
you do one-on-one consulting on this to go over the P&L, see where improvements can be made?
Yeah, so we either we have a fractional CFO, which is generally we don't recommend fractional CFO until you're 3 million in sales or more. But we also have advisory services, which is a little bit better for the companies that are 0 to 3 million. And yeah, we have a couple different options of like sitting down and if you have a bookkeeper already or somebody on staff, recommending certain ways of making the P&L look to be able to create our own metrics or plug it into our pro metrics. If you're a company that say has predominantly a lot more van line revenue, for example, the metrics can be a little bit different. Because say you don't have any marketing expense related to that, right? So the metrics are a little bit different.
They
So
should.
yeah, we do consulting from a fractional CFO or an advisory perspective, just kind of depending on how much time is required or needed from either myself or a fractional CFO on staff.
I love it. And I know you guys didn't come here to hear my voice and my insight on this, but I want to regurgitate what Brock said. Like, if you are doing $2 million, $1 million, even less than that, and you have a fractional CFO, it is most likely a big waste of money. It's just a way to get a bigger payout from you when really you just need very clear accounting and bookkeeping and clarity into your P&L. And so I highly suggest you look at your expenses and go, what am I doing? Because as a business owner, it is our job to understand the clarity we need. And to be honest, a fractional CFO is not going to understand the business like you will, and you're not going to get the value that you are most likely paying for this fractional CFO until you get into that 3 million revenue or more. So I'm so glad you said that. I have another question in here. I've got a lot of questions. I would like to know who is paying less than 3% in truck leases and who do they lease with? That's a good
Yeah,
question.
that's a great question, right? And the reason is we want you. Oh, and here's another conversation. We want you to own your trucks. And we almost want to penalize your gross profit if you lease them all. The companies that we see that thrive and have the most net operating income are the companies that own their trucks, and not garbage truck. Pun intended. Not trucks that are garbage, but good trucks that they're rotating. That they have a capital expense budget for to replace. Every company we have rents some trucks because you get into the busy season and you have you have a need for it, right? But the reason that we budget 3% for truck lease and rent is because if you're paying 7% of your sales for your truck lease and rent, it's killing your net operating income. And when you pay those, you're not getting any equity from buying the trucks. If you have a loan on a truck, half of the loan you're keeping through principal payments, right? The other half is interest. That's an expense, absolutely. But from what we've seen anyway, and I say this all the time, you get a good Cummins and Allison and a relatively newer truck that hasn't been worn its gears down. It's gonna be good for you and it's gonna be profitable for you. So that's why we have that.
I appreciate it. Quick question on this. Do you have a sister company or someone you can recommend with these deep insights in the moving space in Canada?
Ah, no.
I hear Canada is going to be the 51st state soon, so it'll all come
Hey, I
together.
think you're
So
right. I think you're right. Yeah. We don't. I'd love to look into expanding into the Canadian market. We just haven't done it yet. But yes,
soon, soon.
Hopefully.
This one's important. Then we're going to get to the ones you guys are really waiting for. Somebody said on this, and Brock is not paying from this. We've been using Brock services for the past 7 months, and it's truly, literally one of the best decisions we've ever made. Thanks to him, we have so much clearer picture of our finances. His expertise has been game changer for our business, and highly recommend it. So,
Goodness
I mean, what a
gracious.
kudos to you, man. That's phenomenal. So,
Wow. Thank you so much. Goodness. I'm so happy. Goodness.
yeah. That you really are doing a
Wow.
great job. David
Wow.
says this: can the LLC entities make profit from each other? For example, can the truck holding LLC make a profit from leasing the trucks to the other LLCs, or if one LLC branch does a job for the other branch, can they make profits? Kind of share some insight on that.
Yeah, absolutely. Because and losses as well. They can have losses as well because they all flow up to the parent, right? So it doesn't really matter what what the profit is or the loss is. What we generally recommend though is you don't want one company that you have to continuously fund, right? So we don't want you to have a ton of high management fees at the top billing your moving company, and therefore then you have to like keep injecting cash into it. We don't want that. But yeah, the different companies in the holding not the holding company, but the truck leasing company, the real estate company, or something like that. Yeah, they can show profits and loss, but it all rolls up into the parent anyway.
Got it. So I have an airplane and an LLC owns the airplane. Technically, it's a business. I have to keep putting funds into that LLC.
Mm.
You're going, probably not the best thing happening because I'm doing that.
Well, and thinking about that, so I talked about net operating income, and then I talked about net income, right? Net income is net of depreciation and all that stuff. Net operating income doesn't have depreciation yet added to it. If you have a carryover net operating loss, right, not counting depreciation, but you show a loss without depreciation, the IRS can technically, while that gets carried forward, can go back and audit you, and they are not subject to the statute of limitations. So if you're showing a loss like that, you can definitely open yourself up to audit long term because of that net operating loss.
Good to
So
know.
yeah,
Sell my airplane.
yeah. So yeah, no good, no good. Or I
If
mean, or rent it.
Yeah.
Right.
Well, I'm trying. I'm trying to make the IRS happy. If the IRS is here, I'm doing everything by the books.
Yeah,
Um,
good, good, good.
if the trucks are leased back to the company, how would there be a tax benefit if the truck holding company shows higher revenue?
There's not really a tax benefit. It's more a reporting benefit, right? Um, and a liability benefit, right? Because you're segregating the liability. Um, yeah, there's not a particularly a tax benefit. Now you also have to remember that truck holding company is going to be a bulk of your reduction of taxes because that's probably mostly what you're going to be able to use for depreciation. So when it all rolls up, your moving company is probably going to make a lot of money for net income purposes. That truck holding company is going to massively reduce that taxable obligation.
I love it.
But it's not going to like uh, the purpose is so that you're not skewing your income statements for your other companies. So no, it's not gonna it's not gonna cause issues.
Great. I appreciate it. And I'm going to just put a disclaimer out. We'll probably go for another 15 minutes answering Q&As. If Brock is short on an answer, it's not because obviously his lack of knowledge. It's because I'm forcing him at gunpoint to be a little swifter in his responses because we have a lot of questions to go through. So you cannot hold this against him. Are you ready, Brock? What
Ready.
is the best tax and financial approach for a multi-location moving company? We might have already gone through this, but maybe sum it up and give your two quick insights or something.
Yeah. As far as tax approach, the approach that I showed, having a parent company hold the subsidiaries, that's the best way we found it. That's the cleanest way we found it. But the big thing that you need to remember, and it's not necessarily tax, it's more liability. The biggest thing you need to remember is that the companies need to be independent of one another. Because if you, like I said, if you pierce that veil, it really, really opens you up to legal liability, right? From a tax perspective, though, depreciation is the name of the game, right? And so continuously growing, continuously having either if you have the entities own the truck, so be it. If you have a truck holding entity continuously buying trucks, so be it. Either way, continuously growing and adding new trucks to the fleet is the best way to reduce your taxable obligation, bar none. There's really no way around it. Eventually, if you guys stop growing, you're eventually going to pay the piper. But while you continue to grow, continue to buy new trucks and rotate those trucks, that's the best way that we've seen to reduce taxable obligation, bar none.
I love it. Thank you so much for answering that. Next one is what's relatively speaking better for a moving company owner, cash or accrual?
Okay. When from a reporting perspective, we generally say this is a cop out, but we generally say a hybrid, right? Because most moving companies that we have, they do not have high accounts payable or accounts receivable. So you're not paying a lot of things net 30 and you don't have a lot of clients that are paying you net 30, like after 30 days. A lot of your revenue is getting paid the day of the move, right? So therefore, from an expense perspective, a lot of times cash basis is fine. From a revenue perspective, though, if you have the ability, it's nice to do accrual because naturally, you're taking, like I shared in the example, you're taking a deposit early on before you get paid. That all of those deposits are not categorized the same day as the expense related to the move. So we like to have that all together. Again, if you're looking back on a trailing 12, for the most part, if you're doing the accounting yourself and accrual just makes your head spin, cash basis will work just fine. But you just have to remember, if you're looking at it on a month-to-month basis, there could be skewed results. If you're holding checks, until the end of the month or the end of the year or whatever, you could have some skewed metrics. So that's all.
What's a
But
check?
from a tax perspective, a lot of time, almost always, we're either doing cash or hybrid, as opposed to accrual. We almost never recommend accrual for a company until it's like 25 or 40 million or something. Then you're kind of required to do accrual by IRS standards. But until then, we'd say no.
25 or 40 mil. I
Mm-hmm.
could take that soon. All right.
Something like
Mike
that. Yeah.
says, can we keep all of our moving staff as contractors?
Probably not.
Yeah. Yeah.
Probably not. If you're in California, definitely not. Um,
Mm, time to move.
there are I don't know them off the top of my head, but there are tests that you can do to determine if a contractor truly is a contractor. If they bring their own tools, if you don't set their schedule, if they're allowed to work for other people, those are contractors. But if they're coming in and you're allowing them to use your truck and your tools, if you're telling them when to show up and when to when to go to the job and how to act, they're probably a W-2 employee. It looks like you might have posted something down
Yeah.
there. Okay.
Yeah, I've seen people get away with it illegally and be fine. I've seen people not get away with it. I choose to run more by the books on this with the IRS myself, but the IRS does have that thing that you're referring to that I just posted in the comments for you
Mhm.
guys there.
It's governed from a federal and a state perspective. So some of the states
Mm,
are really sticklers on it, and some are not. Again, I keep going back to California. California's workers' compensation rates are really, really high, and for a lot of states, you don't pay workers' compensation on contractors. So the worker, for us, BWC, Bureau of Workers' Comp, or whoever you guys have, in, say California, for example, I use them a lot. They want their workers' comp money. And so that's why they don't want you to have contractors, because they don't get any workers' comp money from that. So they're a lot more sticklers than most, but
I love it.
New York too.
So Nate says, can we use your services fractionally or is it a package deal? I have a bookkeeper, but I could fire my CPA for all I care. How do you play that game? Like if someone's like, I want 3 digital marketing companies doing my SEO, I'm like, go for it, but we won't be
Yeah.
one of them. Are you like, hey, we can work with all of it? Or are you like, hey, it's best to go all in bundled? How does that work on a high level for you?
Yeah. I would say from a advisory perspective. Oh, I mean, we have a fractional CFO client that has a bookkeeper on staff, right? And really, as a fractional CFO, we kind of run the accounting department and reporting department. Fractional CFO is much more than just a controller, right? We're looking to project and forecast and budget. So as a fractional CFO, yes, a lot of times we'll oversee bookkeepers, but then when it comes down to advisory services, which are much less costs, but obviously less time consuming as well, we'll manage a bookkeeper and we'll give recommendations and things like that. But it's not nearly as hands on, if that makes sense. But it's a lot more of the metrics, some of the metrics we're talking about.
Yeah. Okay. Right now, Amber says right now each location is filing, I assume, because I can't read, because there is a partner at one location. Should each location file separately or holding company file all other
Mm.
locations as an S corp and that location as an LLC? I'm sure that's a long answer. Maybe keep it as brief as you can.
Well, you know what? In order for so those subsidiary entities are called pass-through entities, right? And so basically, because there's common ownership in the top, those forms just flow through. But if there's not common ownership, then it can't as easily, right? So that is going to be a little bit different circumstance, especially when it's a partnership. Yeah.
Love it. Cool. Thank you. Andrew says, I went to apply for a loan, personal loan last year, and they said they said my income looked lower because the taxes were separated from the owner income. What benefit is there to be separated this way if it reduces the opportunity to receive funding or lowers the amount of funding, or at least this is what happened in my case. We are an LLC treated as an S corp. If you don't want to answer that question, that's okay, but that was a
I'm just
question.
trying to think um, how the taxes would be separated. Um, if if for some reason the company, like if you took a draw from the company to pay for taxes and you told the bookkeeper to call it tax expense, then yeah, it's going to lower your net income. It's not right. So it should be an owner's draw, PS. But for the yeah, I mean, hey, being a business owner, it's always tough to get a personal loan because they want to look at the earnings of the company. And S corp helps because you also have a W-2 wage, but then also remember that every bank that I've ever worked with, whenever they go to look at your earnings, they kind of look at what we would call EBITDA, which is removal, for the most part, removal of the depreciation. So it's net operating income. Most of the time, that's what they're looking at. If it's something related to taxes, though, here you go. S corporations do not pay tax. S corporations don't pay tax. C corporations pay tax, right? Corporate tax rate. S corporations don't pay tax. S corporations make an earning, which goes on a K1 to the person, to the owner. The owner then pays personal taxes on the earnings of the earnings of the S corp.
Yeah, and I
So
think it's a common misnomer, and correct me if I'm wrong. You are an S corp. At the end of the year, you have a net income of $100,000. You are going to pay taxes at the end of the year for
correct.
$100,000. You can't just keep it in the bank account and be like, I'm not going to get taxed on it. Correct?
Correct.
Good.
Correct. That's why we love depreciation. Depreciation is the best way to reduce that expense. It's the best way. You can look at all these funky Augusta rules and all that stuff, and I'm just telling you, from what I've seen in the tax rulings, be advised. Like it's
Yeah.
gonna use it for what it's meant for.
Yep. Exactly. Mark says, if you have multiple LLCs, are you funding the trucking company from the other operating LLC so that the trucking company shows revenue and can purchase the trucks? And how would you allocate this in the GL statements, which I don't know what a GL statement
Yep.
is.
General ledger. Yeah.
Ah,
So
that's why I'm not.
we like to set, if you can, we like to set it up so that the moving companies pay kind of a lease to the truck leasing entity, and that lease produces profit. We want there to be some profit because we want you to really have a capital expenditure budget in that truck holding company. So if it kind of builds up some cash, then you can use that to be able to buy another asset. You can always fund it from the management company, right? But for the most part, we would like it to show some sort of profit. So it's kind of helping you budget as well through a whole different entity, and so it gets enough money to be able to buy the assets. Yes, but from a GL perspective, it's just a truck lease from the moving company. It's just the moving company's paying the truck leasing entity a truck lease, but the truck leasing company then is paying the loans for the trucks if there are loans on them, and the difference it's profiting, right? But again, all that profit flows up to the parent. That's how we recommend it anyway.
Okay. I have a question that I'm going to just bring out so that my team can record, and we're going to ask you on the podcast. But
Oh boy.
it seems like there's a lot of work, and it's like, for what gain? Because as a business owner, I'm sitting here like, that seems like so much convoluted work just to save a little bit on taxes, or is it just purely to make sure that there's clarity on the LLCs? So I'm going to make you not answer that now, but I'm just putting that out there so they can get it. I've got another question. Taylor says, is Tennessee strict with contractors? I'm assuming the answer is yes, most likely, and it's federally strict.
It is federally strict, and again, you should live above reproach and do it right, because if you do get audited, yeah, the question is, are you going to get audited, right? You should do it right, thinking you're going to get audited and live above reproach for it. Is Tennessee strict on it? I don't think they perform as many audits as some of the states, but the ruling still stands, right? So they're all strict, but some are just more strict than others. Some have additional rules that the Fed doesn't have. I want to say, off the top of my head, I didn't think that I compare everything to California, and I know Tennessee is not as strict as California, right? But it doesn't mean that you can easily get away from it either, or that if they find out that you're paying only contractors, you're gonna owe a lot of money.
Mm.
So if they're employees, pay them as employees.
Okay. Can the ownership be different between the holding company and the other companies coming off that branch? And how does that work?
No, no, the ownership has to be the same.
Because it's under the S corp.
Because it's under that S corp. Now the S corporation can own an entity that is a partnership, but it flows up differently, right? You can just get into issues if you have other partners that are subsidiaries of that. So again, talk with your tax accountant and see if you can, if you
Okay.
have that structure.
Josh says, I've heard of some type of, and we've got like five or less questions. So you're almost there, Brock, and we are
No, that's
super
fine.
appreciative. And this has gone way longer, but it's worth it. And
Yeah.
again, you guys are going to get annoyed, but please, Instagram, Facebook, tag Brock, let it be
Please, yeah.
known. Get on
Thank
the
you.
get on the Facebook groups, shout in one of the comments, give him that encouragement publicly because that helps his business a lot. But Josh says, I've heard some type of tax benefit for a truck holding company to own the trucks and then lease back to the company, like kind of like what you said. How would there be a tax benefit if the truck holding company shows a higher revenue? An example, the truck holding company buys for 30,000 and leases back to the main company for $4,000 a month, and that's now $48,000 a year. This may be an exaggerated example, but how would there be a tax savings if there's a higher revenue reflected in the truck holding company? I don't know if you followed that. I did not, but maybe you did.
It all flows up to the parent for the most part, or the I guess it could flow up into individual. Again, it's going to depend on how you have it taxed. If there's not a parent company and it's flowing up to you personally, like if you personally own this entity and an S corporation owns the holding, or a holding company owns this, or if one's an S corp and one's not, that will definitely change. A lot of times what we'll see is they'll have an S corporation holding company and a single member LLC that holds the truck leasing company, and then absolutely the earnings are absolutely different and less advantageous to have the truck leasing company make more money, right? But if it all flows up into the same place, then there's no tax advantage, no tax disadvantage or advantage.
Whether one's profitable, one's not, because it's
It
all flowing up.
Yeah, again, doing accounting this way is to have accuracy and reporting to make decisions. You can probably run everything on spreadsheets and at the end of the year look at the bank accounts and have your tax accountant prepare it. Now it'd take forever to build it, so you're going to be paying an arm and a leg on your tax accountant to be able to prepare it. But we want to have accurate information so that we can make good decisions. So that's why we recommend doing it this way, so that you can have as accurate information as you possibly can without overdoing it too much, kind of going full accrual. A lot of times we don't recommend that, but we want to be able to make good decisions, and that's why we recommend it this way. Anyway.
Beautiful. Now, you are so generous. You're going to share that PDF that you had out today,
Sure.
correct?
Yeah,
Um,
more than happy.
because somebody asked, how can I structure my P&L for me as an owner to make business decisions? And I think what you already have shown is like one of the best ways to do that, because there is that tension and balance between what an accountant wants to see and what you need as an owner. And so it seems like what you showed on that PDF is a really good hybrid happy medium to kind of
Mhm.
give the best of both worlds, correct?
Absolutely. Absolutely. Yep. More than happy to share this. You guys can take a look at it and change whatever you like. Again, do it how you feel. The big thing is, are you staying up on it? Is it done right? Are you reconciling it? Are you reviewing it monthly and making decisions on it? That's the big thing. So I don't care what format you have. This is the format that we use and every one of our local moving companies pretty much use, so that we can have our own metrics and our own standards. But if you have your own metrics and your own standards, feel free, please.
Cool. Awesome. And then one person said, "Can we see this pie financial on our financial statements with you? Because that pie is really cool for
Ooh, okay.
myself." Or what he's saying is like myself. I already work with you. I love the pie thing. Could I get that and see that on my own?
Interesting. I'm sure that we could throw that if we think I tell you what, and Travis, I'm sure you know this too. If there's stuff like I try to tell our clients, if there's stuff that like we can easily produce, like that is just a chart, right? If we could easily produce that and put it in our financial statements, absolutely. I don't know if it's in our software or if we'd have to build it or whatnot. So if we have the ability and if we think that our clients would benefit from looking at it that way versus how we have our pro metrics, I am down for it. So yeah, if we can do that.
Awesome. Brock, this has been absolutely phenomenal. Best
Good.
way. Someone's like, honestly, not only do you look good, but you're so smart. How can I get more of you or talk with you or sign up for your services? What's the best way for them to do that?
You know what? promoveraccounting.com. If somebody books an appointment there, it goes to my calendar. I do all I own ProMover, but I do all of our calls with new potential clients. I do a lot of our advising calls too. So
Mhm.
if anybody wants to talk through how we can help them if they need help, or how they can do it on their own, and just get some of this information too, please feel free to go to promoveraccounting.com, or find us on Facebook or Instagram. Shoot us a DM. I monitor that as well. More than happy to help in any way. We just want to, hey, I love this industry and I love the people in it. And if there's something as simple as providing a PDF, good night. I'm more than happy to do that. And if it's working with each other daily, weekly, monthly, yearly, more than happy to do that too. So
I love it. I love it. And you're basically a world-renowned speaker now, speaking on all different places. You're going to be at the Movers Conference in March,
yeah.
speaking on very similar things, even more knowledge dropping. And so I got to give a plug in for my virtual Movers Conference. It is the largest online movers conference, or conference for moving companies out there. It is the most
Wow.
profitable event you will attend because it's dirt cheap. We got
Yeah.
guys like Brock. We got guys like Tim speaking at this, and we even have Louis Massaro. So we're bringing all the best people, guys. So go sign up for that conference, because it's going to be just as valuable as this as well. Man, Brock, thank you so much.
Yeah.
I am going to force you with a bottle of whiskey and at gunpoint to do round two. I think everybody wants it. We'll go in. I mean, you still had 30 more minutes of stuff you could have gone through,
Sure. Sure.
more. And so we're gonna try to work that out in the next month. For
Love it.
those of you guys wanting the PDF, you guys wanting the replay, it's gonna get online by the end of today or early tomorrow. We'll send out a few emails, and go and you'll get that right then and there. There'll be a landing page you can get that. Brock, seriously, thank you. This has been amazing. I'm
100%,
honored that
man.
you joined, and it's just been phenomenal, and everyone has loved it. So thank you so
Good.
much.
Oh, well, thank you guys for the invite, and for the kind words I heard as well. Man, that's why we do this. We want moving companies to be able to make good decisions. And it just totally makes my heart happy when I hear people happy with what we do, and happy with the information they hear. And hopefully we can keep doing it. So,
Well done. We are business owners, guys. Your encouragement is, however, the
yeah.
ways you go about this, get the financial clarity you need in your business, because that's going to help you grow. It's going to help you understand how to grow, how to keep more money, because that's what it's all about. How to invest in trucks, invest in marketing, and get a better ROI. Like, it is the foundational skill set that you can learn as a business owner. So, Brock, thank you so much for being here. Everyone, thank you guys so much for joining today. Again, tag them on Instagram, tag them on Facebook, tag Rotate Digital, go into the Facebook groups, share, comment. That public encouragement for Brock will be great,
Yeah.
and helpful for his business. Go talk to this guy. You all have a wonderful Thursday. Thanks for joining, and we'll see you apparently in a few more weeks, for the round two. Bye,
Sounds
guys.
good. Thank you.
Thanks, Brock.